And it is official. The Nasdaq 100 is in correction territory, seeing a peak to trough drawdown of 10%. The selling continues, tariffs now in place, and Mexico, Canada, and China are retaliating accordingly. So what is the tariff playbook? Will businesses pass those costs on to us, the consumer? Will governments intervene? How much will prices rise? And what exactly does it mean for S&P 500 earnings? We all know that price follows earnings, and any impact to S&P 500 earnings growth with where valuations are right now likely mean there's more downside ahead. So in light of all of this, is it time to get defensive? Is it time to sell? Or is it time to buy the dip? That's what we're going to talk about today. So buckle up, because things are likely to get worse before they get better. Just how low will stocks go? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks eliminated all of their post-election gains as stocks responded to fresh tariffs on Canada, Mexico, and China. Trump-based euphoria has pretty much evaporated from the stock market, guys, as recent tariff escalations and disappointing data have sparked growth fears. There wasn't much green today. A lot of what we saw, you could say, was sort of a dead cat bounce yesterday. Even looking at some of the defensive sectors, look at real estate, look at utilities, they were deep in the red today. Look at telecom services, very, very red, all things considered. Look at consumer defensives, right? These are like quintessential defensive sectors, and we saw a lot of these sectors very, very red today, owing to the fact that what we really saw was a little bit of a liquidation. What we did see was a little bit of a comeback here in Nvidia that stretched out to the broader tech sector. AVGO was up, Nvidia was up, AMD was up. We did see Google gain 2.11% today, and we saw a little bit of upbeat price action in infrastructure. I'm not going to call it anything than what it is. It was simply just a dead cat bounce. I think just shorts covering. And again, just some of that passive buying occurring under the hood. Financials was very, very red. Probably the worst sector here today in aggregate. Everything from Visa to MasterCard, American Express, JP Morgan was down 4%. Berkshire Hathaway. Financials were a bit of a dumpster fire in today's trade. And the ultimate winner out of everything today was really just gold. Gold gained again, the second day in a row where it outpaced equities, up 0.89%. We saw every sector was in the red, with the best performing sector being the XLC. XLK was up 0.06%, and then excluding XLK, we had a huge jump down to 0.82% of a decline in XLC. Healthcare fell, energy fell, real estate fell more than 1%. The S&P 500 was down 1.18%, and it was just a very brutal day, with financials being the worst performing sector, down 3.61%. So, a lot of money just liquidating out of equities today, and it was really value that took the hit. Value, large cap value, mid cap value, as well as small cap value. All of these segments of the market was down pretty much 2%. Large cap growth was the best performing sector, but still seeing broad-based declines across the board, down 0.59%. We also saw just selling everywhere. It's like the fourth or fifth day in a row, apart from that one green day we saw in the S&P 500. So the market not looking really good. We are definitely in some form of a drawdown. The market's kind of trying to put a low in, but I do think there is definitely more pain ahead. And this doesn't illustrate what we actually saw today. If we actually go back to the sector analysis, you could see that at one point, every sector was very, very red here. We actually did make a bounce midday into the close, and then we saw just a little bit of a liquidation into the close. This right here, where you see this type of thing on a red day with growth concerns, this is just the market getting jittery, the market selling out, going to cash, going to bonds, and we'll talk about what that looks like in the charts. Now, part of the reason why we saw some very brutal action today was that tariffs officially kicked in, and today, US tariffs on Canada and Mexico of 25%, total tariffs of 20% on China, and we saw retaliation from both China and Canada, and this is what the retaliation was. So for Mexico, what they said was 25% retaliatory tariffs, almost like reciprocal tariffs. Canada have a package of tariffs up to 25% on $107 billion worth of US goods. $30 billion go into effect today. The remaining go into effect, I believe it's either after the 10th of March or April. And then China's retaliatory tariffs were as high as 15% on US agricultural goods, and then banned trade with some US defense companies. Now, Canada hit back with a sweeping package of tariffs. However, many saw Beijing's response as less aggressive than feared, leaving room for negotiation with Trump. So I think we're going to see a deal here with China. China know their economy cannot handle any type of disruption in trade, and they wanna negotiate with Trump, but they don't want to appear weak, and that is why we saw this number right here. And then Canada and Mexico full steam ahead. Now the problem is, if Canada and Mexico retaliate, Donald Trump has reciprocal tariffs which are coming near the start of April. And Donald Trump put out this tweet. He said, please explain to Governor Trudeau that when he puts retaliatory tariffs on the US, our reciprocal tariffs will immediately increase by a like amount. So I don't know how this is going to escalate, because it's like a circle going around and around and around and around, getting bigger and bigger and bigger and bigger. So I don't know how this is going to stop. But this is the position where we're in right now. The market kind of realized this, and this is why we saw a lot of churn under the hood. There was a couple of good things though. Look at economic data right here. The Red Book Index year over year, right? Up 6.6% this week, up 6.2% last week. Very, very strong numbers. Now, let's just actually talk about what the Red Book Index is, right? So the Johnson Red Book Index is a sales weighted of year over year, same store sales growth in a sample of large US merchandise retailers representing about 9,000 stores. Same store sales are the sales in stores continuously open for 12 months or longer. By dollar value, the index represents over 80% of the equivalent official retail sales. So this is a very high frequency, very high quality data set of the monthly, weekly retail sales report. And what we're seeing right here is that the Red Book Index growing very, very solidly. So that does go to show that, the consumer still hanging in there, still very, very healthy, but this is only a week's worth of data. Now, talking about the consumer, Target reported their earnings. The stock was down 2.54%, and that's because it actually delivered a really great earnings, beat on top line, beat on bottom line. However, their guidance was a bit so-and-so, and this is what the CEO had to say. In light of ongoing consumer uncertainty and a small decline in February net sales, combined with tariff uncertainty and the expected timing of certain costs within the fiscal year, the company expects to see meaningful year-over-year profit pressure in its first quarter relative to the remainder of the year, and that is why Target was down 2.5%. So we actually saw a bit of a downgrade in earnings. However, we did see a double beat, but not a raise, unfortunately. CrowdStrike also reported their earnings after the bell. It was up nearly 2% today, but down 5% after their earnings. So obviously the market not liking it. And that's because Target came out, they actually beat on the top line and bottom line. They actually grew their revenue 25% year over year. Exceptional growth. They beat earnings. Earnings came in at $1.03. The market was expecting 86 cents in earnings per share. So they absolutely smashed expectations in terms of this quarter's earnings. However, their Q1 guide was very, very light. Now, their revenue guide for both Q1 and the full year was intact, right? So the expectation for Q1 was 1.1 billion. That's exactly what management said they would do. For the full year 2026, the expectation was for 4.7 billion. That's exactly what management reported. So the consensus expectations were hit in terms of sales. However, EPS came in significantly below expectations. Now, CrowdStrike reported 65 cents. The consensus expectation, this is for Q1 guidance, was for 96 cents. So there's a lot of costs that CrowdStrike believe that's gonna impact and eat into their overall earnings per share. And then for the full year, management reported $3.40. This is what they are expected to do in 2026. The market was expecting 3.76%, and that is why we saw this big move here in CrowdStrike Holdings. A double beat, not a raise. That seems to be the theme of this quarter's earnings season. And when you lower guidance, the market is not going to reward you down 5%. And I wouldn't be surprised to see the stock down 7, 8, even 9% in tomorrow morning's trade. Now, Intel down 5.28% today, down as much as nearly 7%. And this is because the TSMC joined President Trump at the White House today to announce a $100 billion investment in U.S. manufacturing capabilities. This is obviously seen as a negative for Intel. and that is why we saw the stock getting sold off today. Now, there was very clear outflows in the market, both in the Nasdaq and the New York Stock Exchange. Both saw outflows. Tiny bit of inflows here in the Nasdaq. Net, the S&P 500 down 1.22%. We saw 2,100 advances, 4,100 decliners, and market momentum continues to look sick, with longer term, shorter term, and medium term averages well below the 50% range. And again, if you want to see market momentum continue, you want to see all of these numbers above the 50% range, including these longer term moving averages. We get that, and then we can continue to move higher. Until that happens, expect downward momentum as well as choppiness in the markets as a whole. Now, stocks were very red across the board today. The S&P 500 down 1.22%, the Nasdaq 100 down 0.3%. So the Nasdaq outperformed, but we saw selling in the RSP, the Qs, mid caps, and small caps. However, looking very positive here in the after hours, we're seeing the IWM, the RSP, Qs, and the SPY all up more than half a percentage point. Very positive extended hours price action. Now, on the back of all of the tariff news, we saw the 2-year, 10-year, and 30-year yield rise, respectively, but the dollar did fall. So again, we're seeing the same trade where yields are kind of flattish and the dollar keeps falling. Now, bonds, as a result, did fall. But relatively speaking, look at the AGG. It outperformed almost every other equity indice, as well as the TLT, but still down 1.23%. Gold is definitely that clear safe haven that the market wants to position into. And then we actually did see Bitcoin rise 2% today. Silver was also up 0.8%. Very positive momentum. Now, looking at the dollar, we saw another sharp decline. Now, we said this is a very key zone, the 105 area. From here, we want to find support and either make the next move up. If we don't find support and we break below and use this as resistance, right, we can then go ahead and target the 103 area. Does look like we are going to close below this 105 area, but we're going to see further consolidation and we'll need a number of trading days to determine the position next. Looking at the 10-year yield, look up 2% today, bouncing off this 4.1 area. So the market's saying, hey, this is probably an area where we may see a little bit of bullish momentum in yields to the upside. However, as long as we can stay below, I would say this level right here, the 4.4% level, and ultimately the 4.5% level, we can then find like resistance here. We can then actually continue the move lower, making a lower high and continuing the trend continuation all the way down 3.7, possibly 3.6%. However, we will need to recapture this 4.1% range. So the 10-year yield in a very, very critical area. Now, as for the most part, when stocks begin to rally, the fact that yields went from 4.8 to 4.1 and looking like it's probably going to go ahead and break the 4% mark, that is going to support stocks, particularly smaller cap stocks. Just remember, if stocks sell off and yields come down, that's generally what you want to see. We have actually seen that. Yes, yields were up today, don't get me wrong, but for the most part, yields are in a very clear downtrend, and that has been the case for most of 2025. This is something that I also called very early on in the year. Now, looking at the S&P 500, it was actually a very, very volatile day of trade. If we just zoom in to this candlestick right here, we got a big wick at the top, big wick at the bottom. That means we saw quite a lot of volatility. And this is the type of volatility you get in negative gamma. You can see that we are below the gamma flip. That means we're in negative gamma. If you're above the gamma flip, you're in positive gamma. Generally speaking, in negative gamma, dealers sell into weakness, buy into strength, and you get this very volatile price action. Whereas in positive gamma, dealers buy dips, sell rips, and you get this very favorable momentum price action to the upside. So we saw quite the challenge here from the bulls and the bears. Definitely the bears winning. You can see the S&P 500 down 1.22%. However, the bulls came in a very strong way, bought the dip. Let's actually look at the one-day chart of the S&P 500. You can see that we found resistance right here at the gamma flip. So this is where the bears said, hey, I want to get short. And then we went all the way down. And it just lines up perfectly. You're nearing the last hour of trade. You've had quite a rally in a week that's been very negative with a lot of headlines. Bears are very confident, going to take their shorts here, and that's why you saw the market move down. However, a couple of positive things. We didn't take out the lows of the day. That's very, very positive, all things considered. And we did see a little bit of bullish momentum here towards the end of the day, and we're seeing that continuing in extended hours. So that is positive. However, some of it tells me it could still be a dead cat bounce, and ultimately what we want want to see as investors is we want to see a recapture of the gamma flip right here. We did try that today. However, the bears were too strong. Once we recapture this gamma flip, then we can look at material upside. But until that actually happens, continue to expect volatility and sideways range trading. Now, guys, this was the Trump gap up right here. We've actually gone ahead and broken below that. So like I said, the Trump euphoria is officially gone. All of those Trump gains are officially gone, and that doesn't really bode well. Now, the very, very key area we want to look to is this area right here, the 5700 area or the 5698 area. Guys, if we go ahead and break this area, the next level of support is this line in the sand right here near the 5400 area. So, we really want to hold this zone, because if we don't hold the zone, we are going to move to the downside very, very quickly in the S&P 500. It just so happens that this is also the gamma, the put support level for the S&P 500. The S&P 500 is officially in quite a bit of a drawdown. Again, peak to trough, 6.7%. Nothing crazy. I mean, for everything we've seen, it's only 6%. Just for the record, going back to 1955, the average intra-year drawdown for the S&P 500 is 14.1%. So just to remember that this type of volatility is completely normal. The reason why I think the market's freaking out is because in the last year, we've had nothing but just very, very linear returns in the S&P 500. The Nasdaq 100 down 0.36% today, very similar to the S&P 500, right? If we zoom in, we had quite a lot of volatility. Bears came in, bulls came in. However, the bears came in at this gamma flip zone. And if we go to the one-day chart, we did have quite a bit of price action above the gamma flip. However, we did see selling from this level onward to take us back into negative gamma and negative for the day. Now, for most of the afternoon trade in the Nasdaq 100, we were actually positive, up as much as 1.4%. Very interesting. However, the bears did take us lower and we did finish negative on the day. So very, very interesting trade here. Look, the bears feel emboldened after today's trade, and that is why we're seeing them come in full force. However, things looking very, very constructive, especially if we continue to put in a low. Look, bulls did come in and buy the dip in a significant way at the lows. Yes, there were bears. However, the bears could not take us back to the lows of the day, and we closed roughly in the middle of the candle. So there is some silver lining if you do look at everything in consideration. And again, we're seeing that momentum continue here in extended hours trade. However, we did go ahead, close that Trump gap up move, and on a peak to trough basis, the Nasdaq 100 is down, seeing 9.97%. So we pretty much saw the Nasdaq 100 in correction territory. That is about a 10% pullback from the high. So very, very interesting trade. Looking at the RTY, similar situation. However, the RTY at the gamma flip zone between positive and negative gamma. The bulls took the opportunity to buy the dip today, and that's because the Russell 2000 is well off its highs. We actually measure from here, peak to trough, right? We're looking at a 17% drawdown in the Russell 2000, and this is not even, that's just a 52-week high. If we continue to zoom out, let's go on the weekly chart. You can see that is the high right there. Actually, no, that is the high according to the futures. So we did actually close. So we're about 17% from the highs. And again, the bulls coming in, taking the cake, buying the dip. If we get in positive gamma, we can actually see momentum to the upside. Nonetheless, because we're going negative gamma for all of these indices, our targets remain until we retake the positive gamma. 2017 for the Russell 2000, for the Nasdaq 100, the target right now is still the 19,830 level, and for the S&P 500, that is the 5698 or the 5700 area. So those are your targets until we recapture the gamma flip zone, or unless we actually get data that swings us the other way. That data could come from non-farms, but I do think we're going to see a bit of a weaker non-farms print this coming week. Nonetheless, guys, we are in a drawdown. We continue to be in a daily downtrend and continue to target the lower ends of the range. Ultimately, we want to hold this area right here. Otherwise, it does spell significantly lower levels for us in the S&P 500. Nonetheless, I am looking at stocks that I do like to buy. A stock I'll be talking a lot about EVVTY, actually outperformed the broad market today. Only is falling 0.22%, and most of the day it was in the green. This is the type of outperformance definitely want to see in your holdings. I did buy a bit of that. I also bought a bit of APA Group and TLT. I did buy some bonds yesterday, but for all intents and purposes, guys, this is the type of volatility we get in equity markets. It's still nothing crazy for all of the headlines we're seeing. However, do be aware that we are approaching that correction territory, and very, very soon it's going to be time for us to start taking advantage of the dip. So when I buy the dip and when you should be buying the dip, I will let you know. So go ahead, subscribe, don't miss a single video, and you will know exactly when I buy.
Hey guys, let's talk about sentiment. This is the weekly sentiment poll I put out every single week, and I just ask a general question to gauge sentiment in the community and by extension the market. I asked, how are you feeling about the S&P 500 this week? And guys, coming into this week, 49% of you guys were bullish on the market. This was probably due to the rally we saw on Friday. It was looking very, very good for us to continue that higher. However, after yesterday's trade, I'm sure sentiment has turned. However, it's very interesting to know that the majority of individuals were bullish. Those that were bearish were only 34%, and not many people here in the neutral camp. We actually had 669 people vote, so it is statistically significant. So maybe these sentiment surveys are truly there to be faded. But now we have to ask the question. Obviously, the S&P 500 is pulling back. We're in a bit of a drawdown. Sentiment has turned. Why is that the case? And it comes down to a whole range of factors. The first has to do with tariffs and how that is going to impact the S&P 500 and stocks as a whole. Because at the end of the day, stocks follow earnings. If earnings projections are expected to go lower, stocks will trade sideways to down. Earnings are expected to go higher. Stocks generally will go higher. Tariffs will have a tangible impact on S&P 500 earnings. So as you can see right here, these are the three pending tariffs which go into effect today. 25% here on Mexico, 25% here on Canada, and then 10% here on China, which is actually now 20%. And you can see here that this is going to have a $7.50, $6.10, and $2.60 impact on S&P 500 EPS. In 2025, the S&P 500 is looking to do $266 in earnings per share. And when these tariffs go into effect, you're looking at about a $15 impact to overall earnings estimates. Now, we don't know if this is going to materialize. This is forecast tariff earnings impact based on previous data, but nonetheless, tariffs will have a tangible effect on earnings. And this is why we're seeing the price action we're seeing in the market right now. Coming into the year, we also saw full year 2025 earnings for large cap stocks. This is pretty much the S&P 500 at 14% and 14% here for mid caps as well. And then small caps at 45%. Goldman Sachs have actually come out and downgraded their overall earnings expectations. You could see here that for 2025, their earnings growth forecast went from 11% to 9%, and they maintained their 2026 forecast of 7%. So we are definitely seeing a tangible decrease. So from the start of the year to just yesterday, the earnings expectations went from 14% to 11%. We've now seen a downgrade to 9%. So this has had a material impact on earnings, and this is what the market is digesting. What is the impact of earnings likely to be? You also have to take into consideration that for Q4 earnings so far, they've been very, very good. You're looking at about 17% growth in earnings for this quarter. So Q4 looking really, really good. The future, we are seeing decelerating earnings growth, definitely downward revisions, and the market is grappling with this. Do we continue the strength we see from Q4? Or are we going to see a material slowdown in earnings and the economy? And as a result, stocks are pulling back on this, trying to digest everything. But you also have to understand, guys, that the average S&P 500 drawdown going back to 1955 is about 14.1%, right? This is the average kind of right here. So with the S&P 500 down anywhere from 4 to 6% from its all-time highs, this is completely normal, and we can actually see much deeper drawdowns, and that is completely normal in the grand scheme of things. Now, looking at the overall macro, with the continued impacts of tariffs and the front running of tariffs, what we've actually seen is a deterioration in the Fed's GDP now. Q1 estimates went from about 2.3% to negative 1.5% on Monday, and now they're sitting at negative 2.8%. This simply has to do with how we track imports and exports. Because we've seen a massive amount of companies importing goods called to front run tariffs, the import figures in the Fed's GDP now actually detract from GDP, and that is why we're seeing a negative figure. And again, I am of the opinion that when we actually get the inventory numbers, this is going to tick up in a very big way, but it just depends from what level. Are we going to see a continued deterioration in this number, or are we going to sort of put a bottom in and then move up from there as the inventory build comes into the market? Nonetheless, companies are front running tariffs, and that is going to affect GDP for the most part. It's not just front running of tariffs. We've actually seen a significant deterioration in the data, which has coincided with the pullback we've seen in the S&P 500. Economic surprises are officially below the zero line, meaning that economic data is coming in worse than analysts' expectations. But this is actually kind of normal. You can see that we were well below the zero line beforehand, but we have been, for the most part, the last 6 to 8 months, we've been in this very positive territory, and now we're just sort of reverting back to the mean with regards to that. Nonetheless, guys, tariffs are impacting the economic data. We're starting to see the early signs of Trump policy impact the overall market. And this is how I flesh out Trump's policy. There's a great video of Scott Bessent. I may actually play it here, talking to, it's either CNBC or Yahoo Finance, about what's to come.
Torsten Slok from Apollo, somebody you know, who came out with a note today saying the probabilities of a recession are going up. Is that what your numbers show you?
David, it's early. I do think that we're seeing kind of the hangover from this excess spending in the Biden 4 years. And what we are going to do now is something that I've talked about several times on your show in the past. We're going to re-privatize the economy. And as we bring down government spending, and get the private sector moving again, that may not be a perfect one-to-one ratio, but I'm sure it's going to happen. President Trump said the other day, someone said, well, when does it become your economy? He said probably 6 or 12 months out. I think I would agree with that.
We also are seeing some numbers, some sentiment numbers. The consumer sentiment indicates that inflation expectations are rising. Now, that's not necessarily the hard numbers. We're not necessarily seeing it in consumer spending yet. Sooner or later, this has to come into sync. What do you think the American people get wrong as they anticipate more inflation?
Well, I think, look, I'm not going to question the American people's current conditions because we're still living through this Bidenflation. I think that over the next 6 and 12 months, that as we deregulate, drill more American energy and establish our energy program, and then make the 2017 Tax Cuts and Job Act permanent, get some certainty, that I think that we could very quickly go back to the Federal Reserve target of 2.0%.
We've also talked about the 10-year, and you've indicated that the yield on the 10-year is an important indicator for you. That's on your dashboard as you assess how well the economic plan is doing. It's gone down to 4.2 from 4.4 since the election, but it's still at 4.2. Do you have a sense of, and I'm not asking for a specific number, but a range that would indicate this economic policy is working?
Well, David, again, it's going to depend on how quickly the inflation drops, what the growth level is. But I would say that I believe interest rates have come down more than 20 basis points or 20-something since the election. And the other thing that's important is mortgage rates have come down, and the spread on mortgages versus treasuries have come down since November, which I think is indicative of some of the things that we're going to do in financial deregulation. So the housing market is stuck now, but I would expect that the housing market sometime in the next few weeks is going to unfreeze. The other thing on the economy here is I having been in the investment business for 35 years, I'm used to anomalies, and we've got a lot of anomalies going here, whether it was the tragic fires out in California, the cold weather in the Northeast. So we're not really looking at kind of comparable data. Also, there's been a big jump in import data or the level of imports in the economic data, and some of that may be manufacturers or consumers pre-stocking in anticipation of anticipated tariffs.
Again, if you're looking at the yield on the 10-year, I'm curious about what levers you have as Secretary of the Treasury to pull or push to affect that. You've mentioned financial regulation and deregulation. What about the tax bill? Where are we on that? What will that do to the yield on the 10-year? And what are the likelihood of it getting passed?
Look, I think we're pass fail on the tax bill in terms of we're going to pass. We are going to get it passed. We started this week. I lead something that's called the Big Six. So it's the Treasury Secretary, Kevin Hassett, Chair of the National Economic Council, Senators Leader Thune, Ranking Member or the Chair of the Finance Committee, Senator Crapo, Speaker Johnson, and Jason Smith, who chairs the House Committee. So the six of us have started working on the bills. They're going into reconciliation. So I'm quite optimistic on the progress they're making. The House had a very close vote, but Speaker Johnson got it over the line. And again, I think that certainty will help establish the parameters. And then again, it's the deregulatory agenda and the getting energy prices down. So I think we could go back to target pretty quickly. And David, just for a minute, on the other side, what we're not getting any credit for yet, that I'm very optimistic about, is the Department of Government Efficiency. That I think that there are substantial savings to be found here. And there's a lot of low-hanging fruit. I don't know what the number is, but that's a pretty good story. So back to if we can get growth up through deregulation and permanency in the tax cuts, and then cut spending, because from the first time I was on your show, we talked about this blowout government deficit. So we got to get that down.
Well, let's talk about actually Doge, and how material that is in your competition 3%. I understand you don't have a specific number, but will it be material? Because it is a very big budget. You have to take a lot of money off of the spending side to really make a material difference in that deficit as a percentage of GDP.
Well, David, I think we can make a pretty big hit here, and the way to think about it is every $300 billion is 1% of GDP. So, is there $300 billion of savings there? Maybe. Is there 150? But everything starts moving us back toward the target, and we're determined to get this down. President Trump at the cabinet meeting talked about balancing the budget. He asked me, how soon can we do that? And we'll see. But I do suspect, in terms of waste, fraud, and abuse, I think most of us think in terms of waste and abuse. I got to tell you that I'm slightly shocked at some of the fraud we're finding, and you're going to be hearing about more of that over the next couple of weeks.
And finally, Mr. Secretary, when you went into this job, you had some specific goals of things you thought you could accomplish, like 3% growth, like getting the deficit down to 3% of GDP. Now that you're inside, and you've actually seen it from the inside, are you optimistic about making those numbers? And what's the biggest risk to that?
Look, it's execution, and we go at it every day. We try to, we have our goals. As we said, we've recentered on the 10-year, which is for capital formation, for mortgages. We are working on the budget deal. We are working on substantial deregulation. We're working on the President's policy of energy dominance. And if we get all those done, I think that it'll be easily achievable. But David, actually, I'll take back the word easily. What I am learning in Washington is nothing's easy, but everything's possible.
Okay. Thank you so much, Mr. Secretary. Really great to talk to you. That's the United States Treasury Secretary Scott Bessent.
What the Trump administration wants to do, and this is with Scott Bessent and everyone in between, they want to slow down demand in the real economy to slow inflation by distributing less money to people. How does that look? They want to cut government employment. They want to cut Medicare. They want to cut SNAP food assistance and school lunches. And they want to cut low-income housing assistance. And then as these take hold over the next 3 to 6 months, they want to plan equal amounts of supply-side stimulus to get the private industry moving. How do they do this? Massive corporate tax cuts, reduced financial oversight, deregulate and drill, onshoring, tariffs, etc. And hopefully what the Trump administration plan to do over the next 6 to 12 months is have the downfall from one balance out the one of the other, and then have private industry grow the economy. At the end of the day, when you cut all of these government services, you essentially move people from a low productivity part of the economy, the government, to a high productivity income producing part of the economy. Now, the demand side policies, these policies right here, take effect quicker than the supply side. So cyclical deflation takes hold in about 6 months or so. And then you should see this administration plan to react very quickly with looser monetary policy, switching back from QT to QE, rate cuts. And ultimately what they want to see from this is lower rates in the future and giving more businesses breathing room to grow in the now less hampered US economy. At least that's what I think the Trump administration is trying to do. It's a very, very thin thread, but what I will say is that the market's trying to price that in, and we are definitely going to see pain over the next 3 to 6 months, maybe as long as 9 months for most of 2025. Nonetheless, I'm still bullish on this administration, and I'm still bullish in the very long term for stocks that have been through far worse and come out better on the other side. Looking at data and earnings for the rest of the week, Tuesday just had its day. So tomorrow before the open, A&F, Abercrombie and Fitch, Foot Locker are the two big names reporting before the open. Actually, ISKD Riskify. This is a business I've been doing a little bit of research into. I didn't realize they were actually reporting. This is a very, very awesome software as a service business that has a huge runway for growth. Very interesting to see that. And we also do have Brown-Forman reporting here before the open. Then after the close, we have Marvell, Rigetti Computing, Zscaler, MongoDB, Viva, Victoria's Secrets, LendingTree, Kodiak Gas Services, and Landbridge. So guys, still a very, very big day here on Wednesday. Quite a number of software names reporting, consumer names as well. That's really going to tell us where we stand for the most part. And then data tomorrow, we get the ISM Services PMI. We also get the S&P Global and Composite PMIs, ADP Employment, factory orders, and then the 30-year mortgage rate. So some high impact news, particularly on the manufacturing side, as well as ADP, which is a read-through for the non-farms print that we do get on Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.